Hello, welcome to your monthly market report. It is May of 2025. My name is Kate Rezebeck, and I'm thrilled to be here with you this month, talking about the most important things in the housing market. We're going to cover two key topics, prices and mortgage rates today. I know those are on everybody's mind. And we're also going to be talking about the conversations you need to be having with your database. Mission critical to be having a lot of conversations right now to get out there in front of the noise, in front of the confusion, and making sure that you are having the conversations that are high impact, because the agents who have the most conversations right now are the ones who are winning. So we're going to set you up to do that, go through a couple of key topics, and then make sure you have access to the best system possible to make those conversations happen. So let's dive right in. First, we're going to be starting with home prices. What's happening with home prices right now? Well, I can tell you, people have a lot of concerns about prices. They're rising in some markets, they're rising nationally, they're softening a little bit from where we've been, and some markets are even seeing declines. So there's a lot of headlines that are very confusing about what's actually happening with prices right now. And I want to make sure you have the data to be able to communicate that clearly and effectively with your clients. So why are people concerned right now? Well, actually, 70% of Americans are concerned about a potential housing market crash in 2025. This is a survey very recently from Clever Real Estate, and it's really reflecting all of that confusion that people are seeing in the media. Are prices going up? Are they going down? You know, your clients are hearing this and feeling this, and they're starting to think, oh no, here we go again, especially as they start to hear inventory is rising. So we're going to talk about that a little bit today. And in fact, this survey goes on to say that 32% of those who planned a major purchase this year say they're now delaying it. And that includes 1 in 4 people who plan to buy a home and 1 in 8 who plan to sell a home. So people are concerned, they're not sure, and when people are confused, what do they all do? They all do the same thing, and it's nothing. They're silently pausing their plans because they don't understand exactly what's happening in the market. And that's where they need to hear from you, with data, with facts, where you can control the narrative with facts, not fiction. So I want to set you up with that today. So let's take a look at what Business Insider says. Though many Americans believe the housing market is at risk of crashing, economists who study housing market conditions generally do not expect a crash in 2025 or beyond, unless the economic outlook changes. So there's a lot of economic factors that we're looking at. We're looking at inflation, we're looking at the impact of tariffs, of all of these things that are in the media right now, and they're causing consumers to have concern. But the people who follow the data, that have followed it through 2008, through 2020, all the way through today, are saying unless something significant changes, the housing market is not expected to crash. Now, why is that? Well, Mark Fleming from First American says there's just generally not enough supply. There are more people than housing inventory. It's Econ 101. And that is the basic fact. There just aren't enough homes for sale to meet demand. Now we know demand is easing and we know inventory is rising, so that's where the concerns come into play. But let me put this into context for you so you can see exactly what we're talking about here. If you follow along with us, you've seen this graph before. This is data we've pulled from Realtor.com, and it says the supply of homes for sale is improving, so more inventory, but it's still low. So this is the percent of national inventory change year over year versus pre-pandemic. So that blue bar on the left is showing you that compared to this time last year, inventory is 30% higher. That's a big jump. And that's the inventory that buyers have been looking for. Now, on the flip side, it says compared to pre-pandemic, it's still 16% below normal. So what does that mean? Yes, inventory is rising, that's softening home price growth, that's creating more options, but it's still far below pre-pandemic norms, what we saw in 2017, 2018, 2019. So it can't cause a crash. There just isn't enough supply. So what happens when inventory is rising, but it's still far below normal? Lawrence Yun says, home price growth will moderate due to more supply coming onto the market. Having income and wages rise faster than home prices are welcome to improve affordability. So what does this mean? We aren't going to see prices skyrocketing as fast as we did several years ago, that unsustainable growth, but we certainly are still seeing continued moderate, healthier home price growth. I'll show you what that looks like nationally. You can see home price growth is moderating. So if you look at the latest data we have over here on the right from FHFA, home prices grew year over year about 3.9%. Now, a year ago, in February of 24, they were growing year over year about 7%. So you can see that pace is slowing down, but it's still growth. Now, again, this is going to vary by market. There are some markets where we're seeing more growth, some we're seeing very moderate or maybe even flat growth, flat home prices, and some where we're even seeing declines, and that's where people start to get scared. But what I want to remind everyone is that home price growth has also increased over the past 5 years by over 57%. So way above normal rates, way above normal appreciation. What we're starting to see now is more balanced, more normal appreciation. Yes, some highs and lows in various markets, and experts expect that home price growth will moderate even more over the next year, probably closer to about 2%. But as we look at the bigger picture, we don't expect prices to crash because there just isn't enough inventory. Are we going to see prices slow? Absolutely. Now, Freddie Mac says we expect the pace of house price appreciation to moderate from the levels seen in 2024 while still maintaining a positive trajectory. And that's welcome news for the housing market. That's what we've been waiting for sure. And to sum this up, Lawrence Yun says again, there's just simply not enough supply. So the economics of supply and demand, if there's a shortage, prices simply cannot crash. And that's a really important conversation to be having with your clients right now. They need to understand what the data actually says. Otherwise, they're going to pause their plans, they're going to step back, and they're going to say, I'm just going to wait because I'm scared. They need to hear from you. And the more you get out there and talk about this, the better. Because people won't always raise their hands. They won't pick up the phone and call you and say, hey, what do you think about prices? Should I move? They're just going to silently kind of slow their pace and pause and wait and see. And the more you can have the conversations that help them understand what's actually happening, the better for you, the better for your business, the better for your clients that you serve, and the more impact you can have on the housing industry. So, what's another topic that's on your client's mind? We know prices is out there. We know they're worried there might be a crash. You've got to ease those fears. But people are worried about mortgage rates as well. They're wondering, when are they going to come down? What's happening? Well, I'm going to walk you through what's happened over the last couple of months, what we're looking at now, and what we can expect in the future as we look into the next year to 18 months for mortgage rates. Now, remember, mortgage rates are the hardest thing to project in the housing market, but we're going to walk you through what the latest data shows. So let's start with where mortgage rates have been over the past couple of months. We saw a lot of stability in March, and then that flipped to volatility in April. Now, we always say mortgage rates are going to be volatile. In times of uncertainty, this is what happens. And that's exactly what we saw here. So they kind of eased along around that 6.75 range, maybe a little higher, maybe a little lower in March. And then we saw in April a lot more talk about what's ahead for the economy, what's happening with inflation. There's concern around what's the impact of tariffs. There's a lot of conversation that created uncertainty in the housing market, uncertainty in the financial markets. And so what that does is it creates volatility in mortgage rates. So we saw them go from kind of what was the lowest point of the year for mortgage rates to the highest point of the year for mortgage rates in less than a week. And that's what you can see right here, that big swing in rates. And that's all due to what's happening in the economy. What can we expect? When can we see more stability and more predictability to be able to focus on where do mortgage rates go from here? Now, the Federal Reserve is meeting this week, and we're recording this on early May, so May 5th. They're meeting over the next couple of days, and they're going to be looking at what's happening in the economy. They're going to look at that broader economic spectrum. I'm going to show you in a minute what they're looking at from inflation, what they're looking at from employment, all those different things. And their actions will dictate what's happening in the broader economy. Now, what Jerome Powell has said coming into this meeting is, as the great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity. So we don't expect that the Federal Reserve is going to make any moves on the federal funds rate in this next meeting, but I'm going to show you what they're looking for and what we anticipate happening later this year as they see more clarity and more certainty in what's happening in the economy. And again, they don't set mortgage rates, but when they make moves on the federal fund rates, they hope to influence them. And that's what we're looking for in the months ahead. So what's happening right now? Well, inflation is easing, but it remains elevated. So over the past year or so, inflation has kind of remained stubbornly high, we'll call it, above the Federal Reserve's 2% target rate, which you can see in that dotted line. But last week, the inflation data for April came out, and we did see that inflation eased slightly. So that's a positive thing for what the Federal Reserve is looking for. We're seeing what would be a signal of a slowing in the economy, but it's still higher than their 2% target rate. So they're looking at a variety of different factors. They're trying to see what's going to happen with inflation. They're trying to anticipate what's the impact from potential tariffs down the road that could potentially have an impact on inflation. They're trying to weigh all these factors, looking for greater clarity. 1 month of easing isn't what you would call a trend. So they're kind of sitting here looking at this and saying, okay, we've got to keep watching. Now, what they're also looking at is unemployment rates. So unemployment, as you can see in the latest release that just came out last Friday, held pretty steady at about 4.2%. So what they would be looking for is a slowing in the economy, which would be unemployment rates ticking up. We haven't seen that yet. So again, still looking for greater clarity before they make a move. What we know is that as we look at what the expectations are in the months ahead, we watch the CME Group. They have a forecasting tool, and it's showing that we can expect that the federal funds rate will probably be cut 3 to 4 times this year if the Federal Reserve starts to see the signals in the economy that they're looking for. Now, that's not anticipated for the May Federal Reserve meeting. In fact, I was looking at the CME forecasting tool a lot over the past week, and it's hovering around 95 to 99% probability that there will be no cut in May. However, we anticipate that there will be more throughout the year. So that will be a signal. If the economy is slowing, we should see more federal fund rate cuts this year. And what experts are doing right now is they're looking at all these economic factors. They're looking to anticipate what is going to happen. They're projecting out what that means for mortgage rates. And what we can see is the latest projections is that mortgage rates are still expected to ease ever so slightly this year. You can see by the end of Q4 2025, probably in the mid to low 6% range. Now, all of this is dependent on all of those economic factors that we just looked through. Are they moving in the direction that they're hoping that will ease mortgage rates? So all of those things kind of come together. We're going to continue to watch them. It's why we stay on top of these things. If you look out a little further, mortgage rate projections through the end of 2026, probably again in that low 6 to 6.5% range. Not too far off of where we are, but certainly improvement, and every little improvement helps. So what does that mean for the housing market? Lawrence Yun says a meaningful decline in mortgage rates would help both demand and supply. Demand by boosting affordability, and supply by lessening the power of the mortgage rate lock-in effect. So as mortgage rates come down, we anticipate that more people will jump into the housing market. It can be more affordable from a rate perspective. You'll see more homeowners say, you know what, my life has changed. I'm not holding on to this 3% rate. I have to move, and I'm feeling more confident in that. And what we also know is that people are concerned about the economy. We talked about at the beginning, 70% of people are concerned that the housing market could crash in 2025. And a lot of that is due to things that they're hearing from recession, inflation, all those different things. Well, what we also know is that even in an economic recession, generally home sales could rise if the mortgage rate declines. And if you haven't watched last month's monthly market report on recession and what that impact could be for the housing market, I want you to go back and look at that, because what do we know is that in 4 of the last 6 recessions, prices actually went up, and in all of the last past recessions going back into the 80s, mortgage rates actually came down. So some of the factors for the housing market that your clients are scared about, they're answered there. And I want you to make sure you're having those conversations, because I'm not saying a recession is or isn't coming. It's certainly something we're still watching, and experts are still trying to keep a pulse on. But I want you to be able to get ahead of those conversations and talk about that, because those are the types of things that your clients hear in the national news, and they're scared. And they want to know, what does that mean nationally? What does that mean in our local market? And the more conversations you have, the more deals you are going to close. And I promised you we'd talk about conversations as we got to the end of this monthly market report, because we've set up a system and a process for you as KCM members to be able to have these conversations, to watch the monthly market report, and then to go into what we're calling KCM playbooks that give you everything you need to get out there and ahead of this fear and uncertainty, and talk to your database about what's actually happening. Because the agents who do that are winning. And they're winning because they're adding value. They're not pushy, they're not salesy, they're staying top of mind, and they're helping their clients understand what's actually happening so their clients and their database can make more powerful decisions. And let me tell you, this is more important than ever right now, because agents are scared to do this. Scared to not have the answers, scared of, feeling like they have commission breath. You've heard all of that all over the place. And if you're feeling that, I want to ease your fears, because having the right conversations repositions your value. And here's the thing. I say this is more important than ever because repeat business for real estate agents is falling. So this is the percent of sellers who use the same agent again in 22, 23, and 24. And what you can see is that percentage continues to decline, because people expect more, they want more, they're looking for value, and they're finding it elsewhere rather than always going back to the same agent. So let's say that, someone bought a house with you several years ago, now they're ready to move. Only 8% of those clients are going back to their same agent. That means 92% of clients are choosing a different agent when they sell. That is a problem if that's happening right now. If it's happening in your business, the way to get on top of that and get ahead of that is to have more conversations. And our KCM playbooks that you have access to will help you do that. And I'm pulling this one up right here because I want to show it to you. It's about having conversations about economic uncertainty. All the things we've talked about this month in the monthly market report, all the things that you saw last month, that recession word that's scaring people. It's how to go out and have those conversations. We give you an email template already written for you. You can customize it however you like, videos to record, follow-up calls to make, texts and DMs to send, social posts, all the content that helps position you as the valuable agent, but you got to go out and have those conversations. We've made it simple, effective, and easy to use so you can be that expert in the market. So hop into your member area, go over to the left nav bar, and check out KCM playbooks. This is one on talking about economic uncertainty. There's several more in there, and every 2 weeks you'll get a new one as well to have the most high impact conversations that close more deals. And of course, why do we do this? We do it because most agents know what's happening, good agents understand what's happening, and only great agents can explain what's happening. Those are the KCM agents who are watching this monthly market report, who are putting it into their business, who are using our playbooks and having the best conversations out there. So thank you so much. That's all I've got for you today. Go out there, have great conversations, and we'll see you back again next month.